If you're entering retirement with rental real estate income and you're trying to figure out what to do, whether it's continue that income or sell and take the capital gains hit, this video is for you. I've discussed in other videos that when it comes to retirement, you need to first solve the qualitative problem around real estate, meaning for many years during working, you either hired a property manager or maybe you managed these properties yourself. But at the end of the day, you had to provide the capital and the time and attention that it takes to manage rental properties. So when you enter retirement, the first decision you have to make is qualitatively, do I continue to want that burden? So before you assess this video, you have to answer no to that question. So if you've decided I want to sell my rental real estate, but I actually have a problem now, I have fully depreciated property, or the value's gone up so much that my capital gain is going to be astronomical. This is why I made the video. I'm going to introduce you to a lesser known strategy called the Delaware Statutory Trust, DST for short. The great thing about that is it's one way for you to continue to defer the capital gains on that real estate and actually enter into a passive relationship that still creates income. The problem that most real estate investors or those that have rental income face when they get to retirement is they've enjoyed the income that their real estate produces, but not the lifestyle. Retirement is a time to enjoy. It's not a time to get that 5 o'clock phone call about the pipe that bursts or some other tenant problem that you just wish would go away. So if you know that that's you, the Delaware Statutory Trust is a powerful tax deferral vehicle that also works in conjunction with a 1031 exchange to defer those capital gains. If you're new to the channel, my name is Forrest Dutton. I am the owner of Brightworks Financial Planning. I'm a certified financial planner, and I love doing these videos. The goal is to help you retire with confidence. Today's video is not personal financial, tax, or investment advice. Please consult a professional to talk about your specific situation. So let's go ahead and talk about number one. Let's define this. What is a Delaware Statutory Trust? Before we define that, we first need to talk about what is a 1031 exchange. So you may or may not be familiar with that. That is named for the section of the IRS code that it is named in. And basically what that means is if you have real estate property and you want to defer the gains realized on the sale of that property, you can do what's called a 1031 exchange. And that basically means that from the time you sell your property, you have 45 days to identify a replacement property, and you have 180 days to go ahead and close on that new transaction. Now, traditionally, 1031 exchanges are just going to involve what's called like-kind exchanges. So if you have some sort of property, you're going to exchange it for another property. That's what's meant by like-kind. So you couldn't take the proceeds and put it into a S&P 500 index fund. That's not like-kind. It has to be another real estate investment. So that's the first thing that needs to be said. The second thing is, because you're deferring those gains, you cannot take constructive receipt of the proceeds of that real estate sale. So you have to utilize what's called a qualified intermediary. So this involves, again, another person. It's often in conjunction with whoever you're going to use for your real estate broker in the deal. There is another third-party group that takes hold of those funds. There ends up being an escrow there. There's nuances, but bottom line is you're not taking hold of the funds. So the qualified intermediary is involved until those funds are then again placed to purchase another property, therefore deferring the gains and not having to recognize them. So where does the Delaware Statutory Trust come in? Well, essentially the Delaware Statutory Trust, it's not what you're thinking. So if you've thought about estate planning and you're thinking, well, it's a trust that I own, it's my trust, my assets go into it. In reality, this is removed from you. You end up being a beneficiary of the trust, but the trust is sponsored typically by a third-party sponsor. So the trust has a sponsor, and the sponsor will take large commercial properties and they will put it inside the trust. And basically, you are going to be allowed to have a fractional ownership share in the trust itself. That's what a Delaware Statutory Trust is. And so it qualifies for that same treatment I just mentioned there, that 1031 treatment. So let's just use an easy example here. Let's say you have $1 million in market value, that is your rental property and it's fully depreciated. So it would have been the full amount of gain, again, give or take. So when you sell that, the $1 million, again, it sits with the qualified intermediary. What you can do then is these sponsors of Delaware Statutory Trusts, they run funds where you can have a fractional ownership in their trust. So you take that $1 million, you put it in the Delaware Statutory Trust. Now, a few things to understand here. This is an investment. They're sold like investments. Typically, you have to utilize an advisor or a broker of some sort to get into these investments. The other thing you need to realize is these are private investments, meaning they are not, there's no secondary market for these investments. That being said, these are only appropriate for accredited investors. So that's someone who made $200,000 for the last 2 years if you're single, and if you're married filing jointly, $300,000 and or $1 million of net worth, not counting your primary residence. So if you check that box, then you are eligible for this type of investment. The other thing you need to understand is the sponsor matters. So these sponsors typically do this as their main business. So you want to make sure you do due diligence to find the right sponsor, because what happens is you're not giving up income when you enter into a Delaware Statutory Trust through means of that 1031 exchange. You will still get an income payout from the sponsor. Now, just like any investment, it could lose value. The other thing about Delaware Statutory Trust to know is they are illiquid. There is a lockup period. So you do not want to put the money in that you need to get out fast, right? So if you're looking for income, that would be a very reasonable reason to go into a Delaware Statutory Trust. So many funds will advertise that they pay between 4 and 5% over that time period. They're going to give you reporting. They're going to either change that based off the value. Most of them are going to be flat. They might increase a little bit, but they could decrease, and that's something that you need to know. But if you're in a position where you know later is a better time to actually take those capital gains, then a Delaware Statutory Trust could be a great vehicle for you. So I've already kind of gone through the mechanics of this, but there's also one other step that often investors take, because really what happens is, think about this. Again, you own a fractional share of this large commercial property. Often these Delaware Statutory Trusts hold things like massive Amazon warehouses, and you would never be able to own some of that on your own. So you have a fractional interest. If you took that $1 million, you do take a concentration risk if you put it in one property with a sponsor. So oftentimes people may want to do this over multiple different investments, things like medical facilities, warehouses, other multifamily housing units. There's other things that the commercial opportunities exist inside these DSTs, but just wanted to say that for clarification's sake. But let's say you get to that point and you actually do it. Well, what happens after 5 to 7 years? You give up total control. So remember, there's an institutional investor. It's not you. They're the ones who own that property through a trust. You have a fractional interest in that trust. You are being paid income out due to how that property is cash flowing. Typically, these are very corporate rated, triple net leased commercial properties. They try to make sure that they are providing return for their investors, but it is an investment just like anything else. There's no liquidity. So over that 5 to 7 period, you have an option. You can either cash out, or you can decide to do another 1031 exchange into another like kind investment, either that DST, another sponsor. You have a lot of options in what you can do at that point. There are fees associated, just like there would be with any investment product. But the other thing that you can do here is you can then execute at the end of the DST period what's called a 721 exchange into an actual REIT. So remember, REIT stands for Real Estate Investment Trust, REIT. So if you were to do that, what you're doing then is you're diversifying, because real estate investment trusts are basically designed to have interest in multiple properties. So you're spreading out that risk. And also what they can do is they then allow for liquidity in a ways that the DST often does not. Now, again, it matters what you do, who you use. Oftentimes you can make that decision before you go into the Delaware Statutory Trust because you know what your end game is. The other benefit to doing that future exchange is that if you were to have that ownership, you basically have what's called operating partner units in that real estate investment trust. So when you have those, if you have an estate concern, imagine owning 5 to 10 rental real estate properties. Even though your heirs are going to get a step up to the value of that real estate property, they still have to make the decisions about what do they actually do, when do they sell, how much do they sell. So this could be another reason why you may want to go into this type of structure, because if you pass away with ownership in this 721 REIT structure, then those can often be siphoned off into your heirs. Say you have 3 or 4 people that you want this to go to when you're gone, those can easily be distributed, and then they can decide, do they just want to cash out of that when they inherit those, again subject to the rules and limitations of the REIT itself. But often, again, REITs are usually known for income. So the reason people own real estate investment trusts is to receive that yield, that income that comes from that investment. So if you're someone who at that point, you know that you're done with 1031 exchanges and you don't want to have to keep making that decision or holding it until death, this is usually the last stop. But I wanted to just bring this up because sometimes people think there are literally no options if you want to continue to receive income from rental real estate, but you don't want to be the active manager, because in both situations here, again, in the Delaware Statutory Trust, by definition, you are moving from an active investor to a passive investor. Now, there are pros and cons to that. The pro is you're not going to get that phone call. The con is you don't get to decide when to sell. You also don't know if that property interest will grow, stay the same, or go down. And you're also signing on for that illiquidity period where you're going to get that income over that time period. So this is just one strategy that is available, and I think it's a lesser known strategy, so I just wanted to do a video about it just for your education. Again, this is not specific advice, and this may not be right for you. It may not be right for many people, but there are groups of people where this is a really good fit for, and I do think this could have some say in terms of your overall tax planning strategy, meaning how would you utilize that time period when you are getting income from something like a Delaware Statutory Trust to execute the rest of your early retirement plan, such as pairing it with Roth conversions and other things that you might want to do during that time period. So hope you found this helpful, and love to see your comments and likes. Have you heard of this? Is this something that you've had experience with? Love to know what you think, and I will see you on the next video.